Let's break down today's economic news and what it actually means for your investments. Without the noise. Markets move today because of three things: economic growth expectations, trade and geopolitics, and signals from housing and global economies. Stock markets moved higher today, mainly because investors felt more confident about growth and trade stability. In the US and Europe, stocks rallied after political leaders backed away from aggressive tariff threats. When trade tensions ease, companies face fewer cost pressures, and global supply chains become more predictable. That's positive for earnings, especially for large multinational companies. This kind of move is often called a relief rally. It doesn't mean all problems are solved. It just means uncertainty went down, and markets like certainty. For long-term investors, days like this reinforce an important lesson. Markets react fast to headlines, but staying invested matters more than reacting to every piece of news. While stocks moved up, bond markets told a more cautious story. Government bond yields eased slightly as investors balanced optimism with concern about inflation and economic slowdowns in some sectors. Bonds still play their role as stabilizers, especially when markets have been volatile. If you own a diversified portfolio with bond ETFs, today is a reminder of why they exist. They help smooth returns when stocks swing between fear and optimism. One important data point today came from the US housing market. Pending home sales dropped sharply, the biggest decline since the pandemic. Housing is often an early signal for the economy. Higher interest rates are still slowing demand, and that tells us growth isn't evenly strong across all sectors. This is why markets can rise even when some data looks weak. Investors are constantly balancing good news against warning signs. Outside the US, some global economies showed signs of stress. Parts of Asia reported weaker growth, reminding investors that the global recovery isn't perfectly synchronized. In currencies, a US dollar strengthened modestly as investors returned to risk assets, but still favored US stability. Gold pulled back slightly as demand for safe havens declined when markets became more optimistic. So what should you actually do with all this information if you're a long-term investor using ETFs? The answer is usually not much. Today's news supports the case for staying diversified across regions, holding both stocks and bonds, and avoiding emotional reactions to headlines. Markets will move up and down based on news you can't predict. A diversified portfolio is designed to handle exactly that. Today's market moves are a reminder that investing isn't about reacting to daily news. It's about owning the market, managing risk, and staying consistent over time. Short-term noise fades, long-term discipline compounds.